people do not prepay their loan earlier. If you do not prepay to the bank anything, you end up paying almost more than double of the amount of the loan. That constrains his ability to build assets from an early age. Let's say somebody starts a home loan at the age of 30. By age 40, he repays his loan and does not build any assets. Then the 10 years are gone. The problem with real estate is that when you want to sell it, you may not be able to sell it at the price you want or the time at which you want it to go. Typically, we look at assets which are financial assets because they are liquid and in the long run, they help you compound your money higher than inflation. And you can only create wealth if you compound your money higher than inflation. So people used to confuse investments and insurance. You should never confuse these two things. These are two separate things. And people were sold endowment plans in the name of investing. These typically are pretty toxic products. And they were happily buying those thinking that they are investing.
I think that was because India's trusted company was promoting that.
Yes.
So how a person should think about the personal finances?
You would see that many of the SME owners do not take regular salaries. Many a times the withdrawal are uneven and many a times they're also laden with guilt because मुझे इसमें पैसा डालना चाहिए. And personal finances are always neglected. So how one should go about doing this is first get your financial plan in place. For that, the first step there is
Namaste and welcome to VK Talks, where we share wisdom and growth stories for Indian SMEs. I'm your host Vishwesh Kumbhoskar. Today we have an extraordinary guest, a MBA from IIT Kharagpur, Ketan Gogte, has had a stint spanning 14 years experience. First at one of Big Fours in management consulting for 5 years and 9 years with companies in strategic business planning, corporate finance and M&A roles. After building an illustrious career, he made a bold transition to become a SEBI Registered Investment Advisor in 2018 with a crystal clear philosophy: capital protection first and reasonable returns second. He is not just an investment advisor, he is a strategic thinker, a behavioral finance expert, and someone who deeply understands the unique challenges the Indian SME owners face when balancing business growth with personal wealth creation. And before we begin, a just quick disclaimer.
please note that all the views expressed in this podcast are purely from an education perspective and not recommendations. Investments in securities market are subject to market risk. Please read all of our documents carefully before investing. Please consult your own financial advisor for any investing decisions.
Welcome, Ketan. So we'll start with a thought-provoking question. You're always talking about long-term investment, financial discipline.
Yeah.
So how this can be aligned with the building and scaling the SMEs?
So first of all, thank you, Vishwesh, for inviting me over here, and let me congratulate you and your team on the good work that you are doing through VK Talks.
Thank you.
Now, these two things are actually very similar. Now, if you look at investing and if you look at building an SME, right, you essentially need 3 to 4 things which are common. So let us go into that. Okay. So first thing is patience. Nothing gets built over time. Nothing gets built the next day. So it takes time. So one needs to have a patience to build a good long-term portfolio for wealth creation, as well as to build a sustainable business. Okay. So first thing is patience. Second thing is discipline. Okay. Discipline of remaining consistent. Okay. That is very important in both these cases. Then the third thing is resilience. Okay. Resilience to, in investing parlance, resilience to ride out market volatility. Okay.
All right.
Because when you are investing in equity markets, markets by their nature are volatile. There are booms, there are busts. So remaining invested through that period actually requires a lot of resilience. And I think the same thing is required when you are building something from scratch, because there will be a lot of obstacles, there will be a lot of issues that you need to tackle and overcome those to build a successful enterprise. Fourth thing is asset allocation. When we say asset allocation in investing, having a right asset allocation ensures two things: that you achieve the growth that you're looking for. At the same time, you also manage the risk. Okay, so it's a two-pronged sword. On one hand, you are gunning for growth, and on the other hand, you are also looking for risk management when you're looking at asset allocation from an investing angle. The same applies to a business when you look at capital allocation, right?
Right.
A good business is that business which allocates capital well. Okay.
Okay.
And the last thing is long-term orientation, right? Compounding is called the eighth wonder of the world, but to enjoy compounding, you have to be in the race for long run, right? And as we go along, I'll speak more about compounding, but essentially, if you look at these 3-4 things: patience, discipline, resilience, asset allocation, and long-term outlook. These are the 5 things which are common in both these things.
Okay. So Ketan, you done MBA from IIT Kharagpur,
Yes.
from such a great institute. How that problem solving and analytical uh, thinking gives you the perspective towards the business, planning a business strategy and investment analysis.
Okay. Okay. So when I went to IIT Kharagpur for doing my MBA, uh, I I wanted to get a perspective of the entire business, right? How the business works. So, if essentially you are a technical person, then you are only focused about your area of
Hmm.
influence. But there, I got exposed to different aspects of business. So, right from sales and marketing to operations, supply chain, distribution, corporate finance. So, this gave me a 360-degree view of how a business works.
Works.
Then the second important thing is, if you are looking at becoming an investment analyst, right? The key thing is you should understand financial statements. Okay. So that taught me how to read financial statements. So P&L, balance sheet, and most important, cash flow statement, which many people do not look at, but I think in my opinion, that is the most important statement that one can look at from a securities analysis. So it taught me, what to look for in a financial statement, how to analyze any company based on its financial statements. And then it also taught me how do you value a company, right?
Okay.
Because for investing, not only it is important to understand the financials of the business, you want to also buy at the right price, and that is determined by the valuation. So
Right.
this gave me actually a theoretical framework as to how when you look at a business, what all parameters you should look at to decide whether it's a good candidate for investing or not. So that actually was, I would say, it was more like a preparation ground for me that prepared me for my next thing.
Okay. You spend most of the years in business advisory services. You consulted with the auto, oil, gas, steel, many industries.
Yes.
So, what the gap you see in between the large companies and medium scale, or we can say large entrepreneurs who have built the enterprises
Mhm.
and the small scale entrepreneurs? What the gap you see? What are the differences in terms of financials and investment, personal finances as well as company finances?
Okay. So it actually, taught me 3-4 things, which I would like to share with you. The first thing is it gave me the boardroom access, where
Okay.
I got to see how promoters think about their business.
Okay.
And one of the difference between how a large organizations think and go about, their business strategy and maybe an SME is the long-term outlook. They,
Right.
look at next 5 year, 10 year, 15 years, and they plan their actions accordingly. That is one. Second thing, in the larger organizations, what I found out was that there was a great, importance given to systems and processes. Okay.
Okay.
So, the decision making was more system oriented rather than, heroic based, which is typically, happens with, small enterprises. That is the second thing. The third thing and most important thing, what I learned over there is that the cash flow is what actually, makes a company great. Okay.
Okay.
So, as the saying goes, right, revenue is vanity, profit is sanity, cash flow is reality, or cash flow is the king.
Okay.
Right? Because most of the SMEs, when they think about growth, they think about revenue. But
Right.
revenue is not growth, right? Revenue is not progress. The progress or the wealth creation happens through cash flow. So a very keen eye on cash flow management is something that is worth taking from these people, right? Then I also got to know why in a particular industry only few people succeed, and most of the people are either mediocre or they are failing. Okay. one of the most important things here to note is the success of an enterprise depends a lot on how they allocate capital. Okay. And when you look at the personal finances, that also defines how, if a person would become a successful investor or not, how he or she allocates his capital. Right. So I think these are some of the things that one can look at. These are what I learned when I looked at these businesses. So it was more like so in my IIT days, I learned the theory. This was more of a practical, or what we call baptism by fire, right? So this was more like that. So you are in there, and the job was to consult them and tell them what where they were going wrong. So that actually prepares oneself to go much deeper, to actually tell these guys as to where they could improve.
Okay.
So that was another thing, that attention to detail is something that I would say is very critical for an SME founder.
And that reminds me, I have gone through one videos. I was just scrolling, and in that video, that person said one thing is clearly, which I hit me most. He said, profit is a different thing, but have you ever discovered what is a withdrawable profit in your company?
Yeah. Right.
You have to monitor withdrawable profit.
Right.
That means a liquidity which the profit which is in the bank, which you can withdraw and used in the capex or used in whatever other investments or other businesses.
Right.
So that hit me a lot.
Yeah, absolutely. I agree, because
that's what you are also currently sharing.
Because profit at the end of the day is an accounting number.
Yes.
Okay. What matters is the cash flow, right? So that's why I'm again stressing the importance of cash flow, because ultimately the wealth is created by cash flow. It's not created by revenue. Many a times, the revenue is funded by taking on debt, right? You can increase your return on equity either through, through a debt as well as through your own equity. But what is sustainable in the long run is, if the company is generating predictable cash flows over the year, then that is something that brings in a perspective of predictability. So essentially for an SME, right, you need three things, right? One is sustainability, second is repeatability, and the third thing is long-term outlook. So I think these things match pretty well with what you're saying. That is something that one should focus on.
All right. Okay. That's true. So in that video उसने भी बोला था कि यार जब भी आपको पैसा दिखता है, आप पैसा निकालो और प्रॉपर्टी ले लो. So he said, why to invest in property only? आपने सब लोगों को पहले से सिखा हुआ है कि पहला नया कुछ तो जमीन या कुछ रियल एस्टेट रहेगा तो ही उसमें इन्वेस्टमेंट करो. सो दैट्स द की पॉइंट कि not only the property, you have to go for a wealth creation.
Yes. So typically, if I'm looking at it more from a financial lens, then real estate is something that I would not consider because it is illiquid. Okay. The problem with real estate is that when you want to sell it, you may not be able to sell it at the price you want or the time at which you want it to go. So for the financial discussion, typically we look at assets which are financial assets,
right?
Because they are liquid. Okay. Yes. And in the long run, they help you compound your money higher than inflation. And you can only create wealth if you compound your money higher than inflation. Okay. So that is actually my perspective. Now, real estate, people do buy. They buy their houses, they buy land. But one thing one has to be very clear is if you are going for that, first you have to see if your financial plan allows it or not. Right? Because debt is the enemy of compounding.
Don't
everywhere.
stretch yourself.
Yes, because what happens is, and especially if somebody is younger, right? See, compounding needs time, right? And money makes money. You need to have money to invest for it to compound, right? Now, what happens is, if somebody takes on a lot of liabilities earlier in his life, okay? So let's say, for example, a lot of people that I see around, young people, they go for buying a house, okay, in their late 20s, early 30s. Now, this is again, sometimes it's a very emotional decision, but if one thinks at it clinically, right, what you should look at is that how much it is constraining your ability to compound your money. Because typically the irony that happens is, let's say you want to buy a house, okay, there is some, let's say 20% you are doing a down payment, 80% is the debt you are taking on, right? So आपका EMI चालू होता है, मतलब आपका मीटर चालू होता है, right? Now, that money, and let me give you an example. So, for example, let's say you have to take a home loan of say 60 lakh rupees, right, for 15 to 20 years, and let's say your rate of interest is say 8.5, 9%, right? Your EMI will be around 60,000 thereabout,
Right.
thereabout per month, right? Now, the other mistake that people usually do is they do not prepay their loan earlier, right?
नहीं, वो पहले बैंक या फिर कई लोगों ने एडवर्टाइजमेंट किया हुआ है ना कि नेवर एंड योर हाउसिंग लोन, यू गेट बेनिफिट इन इनकम टैक्स, बट इन न्यू रेजिम नाउ इट्स गॉन.
No, and more than that, see what happens is ultimately, you are, if you, like I gave an example earlier, if you do not prepay to the bank anything, right, you end up paying almost more than double of the amount of the loan.
Yes.
So let's say a person on a 60 lakh loan, he sits for 20 years, just keeps on paying the EMI, he will end up paying the bank around 1.2 CR plus, right? And not just that, the important thing is that constrains his ability to build assets from an early age. Okay, what happens is people always think binary. Okay, and that's the worst way to look at it. What a lot of people think is, मैं पहले मेरे liability कम करूंगा, right? And at times they also think about prepaying their loan, which is a good thing. But at the same time, if you do not start building your assets, one fine day, let's say somebody starts a home loan at the age of 30. By age 40, he's quite, let's say prudently he, repays his loan and does not build any asset. Then the 10 years are gone.
Yes.
Right? And incrementally, as you age, you have to keep on putting more and more money to achieve the same goal. I'll give you an example of this. Okay. Let's assume that you want to amass a wealth of 5 crore at the age of 50. Okay.
Okay.
Now, there are 4-5 scenarios in this. Okay. Let's say you are a 25-year-old, you are a 30-year-old, 35-year-old, 40 and 45-year-old. Okay. Let's assume that you start investing for this goal. Okay.
Right.
And let's assume that the rate of return or your return expectation is 12% in every case. Okay. Now, can you tell me, if I start at the age of 25, to amass a wealth of 5 crore through investing at the age of 50, how much do I need to invest monthly? And what is my total amount that I need to invest for 25 years? You'll be shocked. So I'll tell you the numbers. So if you start at the age of 25, your monthly investment amount comes to around 26,000. In all 25 years, okay, you will invest around 80 lakh rupees.
Okay.
Okay. And what is important is, with every 5-year gap, so let's say somebody starts at 25, somebody starts at 30, 35, 40, 45, right? From 25 to 40, this monthly amount to achieve the same target at the age of 50 keeps on doubling. And if somebody wakes up at the age of 45, he has to invest at least 6 lakh rupees per month to achieve a goal of 5 crore. So in all, he has to shell out 3.6 crore to achieve a target of 5 crore. So there are two things over here. Not only, when you start early, you give yourself sufficient time for the money to compound. Your capital requirement also is lesser compared to somebody that starts later.
Right.
Okay. And many a times it does happen that, people also have some liabilities and, they are also looking at increasing their assets. So that is where the financial plan comes in the picture. You have to balance building assets and reducing liabilities at the same time. It is not binary 0-1 that मैं पहले liability खत्म करूंगा and one fine day I'll wake up and start investing.
You have to go parallelly.
You have to have a good balance of both these things, and that's what a sound financial plan achieves.
Okay. After 14 years of corporate life, you took a bold decision to shift to the financial advisor. So SEBI Registered Financial
Investment Advisor.
Yes. SEBI Registered Investment Advisor in
Yes. earlier career to
engineering and business background to totally investment thing. And what the SEBI Registered Investment Advisor is.
okay. Okay.
Just explain it.
Sure. So that's a great question. So, what prompted this shift was two things. One was that I had been investing in my personal capacity since quite some time.
Right.
And what happens is, and when I'm saying investing, it's a long-term investing.
Yes.
So no trading, no futures and options, nothing. It's a pure long-term investing. Okay. And I've been doing that in my personal capacity since some time. Now, when you keep on doing something over and over again, you kind of develop a methodology or a thought process as to how one should go about doing this through market cycles. Because in 10 to 15 years time span, you would have seen multiple up cycles and down cycles. Okay.
Yes.
So that, the process slowly was there with me as to how one should approach this. Simultaneously, when I was working, when I used to discuss with a lot of my colleagues, friends, and people in my family and friends, there were many things that I found which people had no clue as to how one should go about doing it. First and foremost is people were investing without any goal. So many a times when you used to ask somebody, क्या कर रहे हो, invest कर रहे हो क्या? हाँ, SIP चल रहा है. Then the next question is, कितने का SIP चल रहा है? So that person would say, okay, 10,000 का SIP चल रहा है. Now, nobody had a clue whether this 10,000 is enough, or you need to do 15,000, or you need to do 5,000. Because the goal definition was not there. See, essentially people have two main goals. Okay, one is their retirement, right? And second is if they have kids, then their education.
Right.
Okay. If one has not planned for this, then it is like you are, आप अंधेरे में डांट मार रहे हो, right? Then it will not take you anywhere. So it was one thing that people were just doing investing without any goal. Second thing that I observed was that there was lack of education among people as to how should one look at investing. Okay, so just to give an example, what you could see around that time, and that time in fact it was higher, somewhere around 16, 17, 18. Now the awareness is slowly going up, but still people used to view endowment based insurance plan as investments. So people used to confuse investments and insurance. You should never confuse these two things. These are two separate things. And the kind of mis-selling that was happening at that time, right? People were sold endowment plans in the name of investing, on which these typically are pretty toxic products. The yield doesn't even match FD returns in some cases, right? And they were happily buying those, thinking that they are investing. This was the second thing. The third thing was this notion.
I think that was because a trusted India's trusted company was promoting that.
Yes, and these guys are very well entrenched, by the way, in the society. So you will find those among your relatives. You will find those among your father's friends and your colleagues' friends, etc. But the problem with that is that neither does it give you enough cover, insurance cover, because the main thing of insurance to have adequate cover, right? Neither does it give you adequate insurance cover, nor does it help you grow your investments. Okay, so this was pretty rampant. I would say the situation is slowly improving, but we have a very long way to go. So lack of education was another thing, because of which people were treating insurance as investment. Okay, the third thing over here was that when it came to wealthy families or rich families, there were large institutions which were there to cater to them. Okay, because they could afford their fees. Okay, but let's say somebody is an individual, or let's say somebody is a SME founder. He wants to start investing on his own with zero capital, or let's say starting from scratch. Okay, then the model of these bigger institutions was not conducive for him, because he wouldn't be able to afford their fees. Right. That is second. The third thing is, more number of times I saw that the products were getting pushed to the customer without ever understanding, and the understanding from the customer side whether this product suits his goal
or not,
and whether it suits his risk profile, more importantly, right? Because
in many cases people don't have the goals.
Yes, that
To
is
be
was
frank
right.
enough.
And many a times such products were getting pushed to people where they were not aware about the risk they are taking by getting those products. Okay, so nobody was looking at this in entirety. I mean, there were very few people. I mean, that time this SEBI RIA registration came in the picture in year 2013 through SEBI RIA regulations. Okay, but what I found out in general was that nobody was taking a 360-degree view of a finances of an individual and a family,
Hmm.
right? And advising them based on goals, at the same time looking at their risk profile, and somebody who could handhold them for a longer period of time. That there was a gap. Okay,
Right.
so I decided, because like I told you, I was already investing in my personal capacity, so the methodology or a thought process was already there. What needed was the trust angle, because see, this relationship between an advisor and a client works on trust. You will only go with an advisor if you trust him or her, right? So the trust factor is very critical. Now, trust does not get established in a day. It's a process, but there are few enablers which help you build that trust. And
Okay.
I'll explain how, what are the different nuances of this advisory model. Okay, first and foremost is fiduciary duty. Okay, that differentiates us from others. Okay,
Okay.
we take fiduciary responsibility. Second is our fee structure, which is very well defined. Okay, so that also brings in the affordability angle, and there is no particular limit as such that you have to start with so and so amount only, and we will not cater to you below that amount. There is nothing. You can
There is
start from
nothing.
scratch.
Right.
Okay, so that also brings in the comfort at the client's level that they can start from scratch. Second thing, third thing is we have to necessarily do the risk profiling of the client. All
Okay.
our advices have to be tuned, looking at his risk profiling, and have to be matched with the detailed rationale as to why we are doing it.
Okay.
Okay. Fourth thing is we look at the overall financial planning of the client.
Client.
So
Right.
there, not only we look at his current income, current expenses, asset liabilities, but things such as uh, how much emergency fund does he have or he needs, right? Because all the time when we think about investing, we look at upside. What about the downside? You have to protect the
Exactly.
downside. So does he have enough health cover? Does he have enough life cover? Okay, these are the things which we look at. Okay, uh, fifth thing is we are very well regulated through these SEBI RIA regulations.
Hmm.
Okay, we get audited independently every year on our compliance.
Okay.
So these factors give comfort to the client that this person out there does not have any vested interest, because we are fee only advisors. The only payment that comes to us from client is our fees. Okay, and
So you don't charge any about
so there are
no sharing, no profit
no
sharing.
commissions, nothing. Okay, and more important is the client is in control, because this is a pure play advisory, right? So just to summarize, what all this brings to the table, I would say fiduciary duty, very great importance given to the compliance and regulations. That gives comfort to the client.
Okay.
Okay. Fourth is very well defined fee structure. Okay, and the fifth thing is there is no particular limit beyond which only this service is available.
Okay.
So somebody can start from scratch as well. Okay. So I think
Okay.
these are the things which typically differentiate SEBI RI or a registered investment advisor from other market intermediaries.
Portfolio management.
There are different intermediaries. So there are portfolio managers, there's PMS, then there are mutual fund distributors. So there are
Right.
different market intermediaries. But this is what differentiates this model from other models.
From other models.
Yes.
Right.
First and foremost, let's say if you are talking about an SME founder, okay, the day he realizes that his family safety need not be dependent on the business risk, uh, that is the time when they typically start thinking about their personal finances.
Okay.
Okay, and once they have that understanding, when they look at our model, that gives them a lot of comfort. When I said the control lies with the client, because he or she does the execution, we don't do execution.
Yeah.
It's an advisory. Okay,
Yeah.
so that also builds a lot of
Trust.
trust and comfort, because what happens unfortunately again is that you would have seen a lot of examples of people where they would have given money to somebody to manage. It could be a relative or a friend. किसी को पैसा दे दिया है, वो बोला है कि मैं इस पे इतना इतना रिटर्न दूंगा. Now, one thing one has to realize is that out of sight, out of mind. Okay. And then there is no traceability. There are many cases you would be hearing. I mean, we keep on hearing that in the media, in the newspaper, we read that,
लेके भाग गया.
लेके भाग गया, there is no traceability, people keep on calling that person. So this is not an efficient model.
Right.
The efficient model is something where you are aware what you are doing, somebody is there to enable you in this journey, and
Right.
you are in control. Okay, so
Okay.
that is how this works.
So, what kind of mental paradigm shift a business owner requires?
Mhm.
Because many SME owners are bootstrapped, like self-funded.
Yes, yes,
Either they have put all their savings, or they have borrowed money from relatives, banks, on personal capacity. So
right,
they have started the business. Now business is running, and they are not able to take out the salary whatever the money they want for the personal finance.
right.
So how a person should think about the personal finances,
Mhm.
and how he can achieve a financial freedom,
Hmm, hmm.
so that whether अगर अगले 2-3 महीने तक बिजनेस में से कुछ पैसा नहीं आ सकता, फिर भी उसका घर चलना चाहिए. वहां पे he needs he need not to think कि
Yeah,
so
right.
he need to what kind of passive income channels he can develop.
Okay. So here, first thing is, and I think the answer somewhat lies in the question itself that you asked. You would see that many of the SME owners do not take regular salaries. Okay, or the salaries are very arbitrary. Okay, many a times the withdrawal are uneven, and many a times they're also laden with guilt. Okay, आप जब पैसे निकालते हो आपको लगता है मैं क्यों निकाल रहा हूँ, बिकॉज मुझे इसमें पैसा
Yeah.
डालना चाहिए, राइट? दिस इज द सेकेंड थिंग. एंड पर्सनल फाइनेंसेस आर ऑलवेज निग्लेक्टेड.
Yes.
Or personal finances are only thought about when there is a crisis. Okay, so what one should think about, how one should go about doing this is, first get your financial plan in place. Okay, your personal financial plan. For that, the first step there is, decide your payout and do it consistently.
Okay.
The amount one can decide, because that is a function of where the business is, how much does he need to reinvest, how much he does need to distribute. That's a separate thing. But there has to be some cash flow that has to come from business on a regular basis to his personal finance.
Finance.
Okay, so that gives us the income stream. Okay, then what he or she also needs to do is look at things like you mentioned that they are bootstrapped. Majority of their capital is locked in their business, and many times it creates a lot of concentration risk. Okay, and many times there is no clear exit, because आपका business है, that is your the only source of income, right? So the first thing is, start paying yourself consistently. That will create the income stream. Be whatever that amount be, that will come from the financial plan. And again, like I said, everything is tied up. So first it starts with goal. Your two main goals: your retirement goal, your kids education goal. That will determine how much you need to invest. Okay, that gives you first answer. Second thing is, if you want to invest that amount, second thing is how you should go about doing the asset allocation.
All right.
Now, most people, what I have seen around, typically do 2-3 kinds of mistakes when they do asset allocation. The first thing over here is something called as an anchoring bias. They do what their parents would have done. So, for example, in our parents' generation, you would see a lot of people either parking their money in small saving schemes, or doing FDs, or buying gold. And if they are a bit savvy, or they have a bit more money, they would go for land or a real estate. This was typically the model, but things have changed. A lot of people are still anchored that my forefathers have done this, and this is what I believe that would help me going forward. So first thing is to get out of the anchoring bias. Okay. Second thing is, your asset allocation should be able to give you growth, at the same time should be able to manage your risk, which means that the distribution should be some like this, that it should give you adequate growth. So for growth, you need to invest in growth assets. which are called as appreciating assets. So there are two types of assets. Okay, there are depreciating assets and appreciating assets. What are appreciating assets? So equity, gold, real estate. These are appreciating assets. Okay, whose value over the time is higher than typically what that value would be, say 10, 20 years back. And this I'm saying in general, as an asset class. Okay. Now, what are depreciating assets? So, your car, iPhone, etc. We are going to depreciate. Okay.
Right.
So the focus should be to be in the appreciating assets and not depreciating assets. Then only you will be able to create wealth. Okay. Third thing is safety. Okay. Because the SME owner needs growth, he needs safety, he needs liquidity, and he needs optionality. Okay. And that is how the asset allocation should typically be, which should be able to cater to all these 3-4 needs of a particular founder. Okay. So like I mentioned, focus on growth. At the same time, don't let go of the safety angle, so that asset allocation should be, more towards the debt component of the portfolio, and something in gold, maybe, which is more like a hedge. Okay, which hedges your portfolio against inflation. At the same time, even within equity, okay, one country, one asset class is always a risk. Okay, so within equity as well, you should try to diversify. Okay, so let's say somebody is based in India, and he or she is going to staying in India forever. Okay, majority part of your portfolio would be in Indian equity assets, which is fine. But at the same time, if you look at the rupee, it keeps depreciating against dollar at the rate of around 3 to 4% average every year. Okay, and there are some sectors which are not available for investors in India because those sectors simply are not present. So, for example, somebody wants to invest in an AI company. We don't have any AI company right now in India, but there are such sectors which are available overseas, and there are investment instruments through which you can take exposure to the overseas assets. That should be some part of your growth asset. Okay. Now the allocation composition will be subject to individual person, but I'm just giving you a broad framework. So within growth asset, you should have your domestic equity, you should have some foreign equity. Then for protection, you should have debt. So within debt, it could be bonds, it could be debt mutual funds, it could be your small savings scheme. So for example, PPF, it's a great instrument. Okay. Then the other aspect of this is also the national pension scheme. So especially for people who are not government employees, this is a great tool wherein you can park your money. There is a lock-in till the age of 60, but it ensures there is a seamless, continuous compounding. And mentally, that money you are parking specifically for that purpose without any drawdown. Okay. So that brings in a lot of discipline. So again, just to summarize, growth assets, equity, then gold for hedging your portfolio against inflation, and it also gives growth. Okay, at times, like you would have seen the
current scenario, the gold and silver is
yes, but
moving like nothing.
But there one has to be careful of there's something called as a recency bias. Okay, one should be be wary of recency bias. What is recency bias? Recency bias is something जो अभी चला है ना. What people do is, if this is working right now, they extrapolate that into future, saying that this will keep on working for a foreseeable future. Okay, so one should not do that mistake. Every investment has a place in your portfolio, but based on a sound asset allocation. Okay, and you should not overdo it. Okay, and what is also important over here is that sentiment is a contraindicator. Okay, because you would have seen, because of social media and there is so much of unsolicited advice that is floating around. Okay, people tend to extrapolate things in the future. Right? So the decision should not be based on whether it has worked for you in the immediate past, but it should be based on your overall asset allocation.
So you are saying we should avoid what intuitional.
We should avoid
intuitional decisions rather than go for a data-based.
Yes, data-driven decisions. So I would put it like this. So we should typically avoid. Nobody should go for quick wins. What you should optimize for is the rate of compounding. And let me explain this. Okay. Now, the temptation for quick wins is the reason because of which you will see there is a decay in a business or
Right.
there is a decay in one's personal finances, because it happens very silently, but it is there. Okay. Now, in case of an SME founder, let's understand why there is a temptation to go for a quick win. Okay. First and foremost is there is a lot of uncertainty. Okay. Then there is a lot of cash pressure, right? Then there is a lot of social comparison, and there is this constant urge of activity.
Okay.
Okay. But let's look at like this. So if I want to draw a parallel to a quick win. So quick win is like a sugar. Okay. Sugar gives you instant energy. Okay. But it comes with its downsides. Okay.
Right.
Compounding, on the other hand, is like nutrition. Okay. Nutrition helps strength over a longer term, right? So what the mindset shift that needs to happen over here is that I'm not going to optimize for speed, but for rate of compounding. Okay. And compounding is something that is magical. Okay. We tend to underappreciate the role of compounding in investing, and even in our lives, and compounding can happen both on the upside as well as downside. Okay. So one has to be mindful of this fact that compounding is magic on both ways.
Right.
Okay. So that's where your asset selection and your asset allocation is something that helps you compound consistently over time. Okay. So what needs to happen over here is that your mindset needs to change from trading, or going for unsolicited advice based on some financial influencer who may not be a registered advisor, doing futures and options. These things one should totally avoid. I mean, I tell this to everybody. Anybody whose primary vocation is not full-time trading should not be into F&O, should not do trading. Investing, based on research and keeping the patience for it to compound over the long run is the best way that I have found where you can create wealth.
Practically, in business, when you are doing your transactions and everything is a different thing, but share market trading is totally different. I have seen many people have lost. They, because they never think that every transaction in the share market attracts the commission of the platform.
Yes.
And where they always forget everything and they sell out by seeing whatever the figures, and at the end of the day सी says यार ये तो लॉस में किया.
See, if you look at it, those people who have got rich, through, if let's take
Share
example
market.
of stock market, okay, you will find that there are no traders in this list. There are only investors.
Yes.
Okay. And what is it that differentiates these people from the compulsive traders or people who look at this as just a trading to get quick money? Is detachment. Okay. So detachment to money is very important for you to make money. Okay. For example, this is a trade that you would observe that those people who invest only for long term, they also tend to open their demat accounts every now and then, maybe 10 times in a day, even without any activity. Okay. Right. So what I tell, I tell this to all my clients that, you don't need to see your portfolio every day unless you are doing to do something. See, market is going to be volatile. Okay. So that's the nature of the beast. Okay.
Absolutely.
But if your investment hypothesis is intact, you know for what you are buying it. Okay. Then you need not have anxiety. Okay. See, the problem with equity is that many a times the availability of it at your fingertips, makes you do things which you are not supposed to do. So, for example, your brain typically is wired to do all the activity all the time. Okay. When it comes to investing, it's counterintuitive. Okay. The more, so your activity does not translate into your returns. Okay. Activity makes you feel good. Okay.
All right.
But that does not necessarily translate into returns. So what you need over here is a sound investment hypothesis. Okay. A long-term approach, and a kind of a detachment to the money, because more and more you will keep on looking at it. Short term price movements will make you take decisions which may not be correct, right? And there's an opportunity cost to it which people forget. Okay, so I think that is where it is. So what I think is that if somebody is whose primary vocation is something different, so for example somebody is salaried, somebody has a his own factory, a business, etc., you should look at capital markets in general as an investing tool and not like a trading tool for quick money.
Okay. We will take a break in this conversation. It's a really interesting conversation and we can't cover it in one episode. So wait for the next episode. It will come soon. Thank you.